Frank lost his card in the mall. He notified his creditor before the card was used, and then someone charged $700. How much is he responsible for? He is responsible for nothing. Okay, and the reason is he reported before money was spent.
What if you reported after?
Okay, yeah. If after, the maximum that he can be charged is $50. So if somebody steals your credit card and they use it before you get a chance to report it, you're probably going to have to pay $50 of whatever they charge, but you won't have to pay any more than that. That's like the federal law.
Even if they max it out?
Yeah, even if they completely max out the credit card, federal law says that you only pay up to $50. Now, if you report it, though, before it's used, they can't charge you. Because it's their responsibility as soon as you reported it to cancel that card to where charges can't go through.
Yeah.
Now, on a debit card, if someone steals your debit card and uses it, you don't have to pay for any of it. What they'll do is they'll launch an investigation, and then once the investigation is cleared, you'll get all your money back. Okay, APR has to be converted into a monthly percentage rate. So you have annual percentage rate, so APR is annual. And what they do is they convert to monthly by dividing by 12. So we're going to take our annual percentage rate and we divide that by 12, and we'll get our monthly percentage rate, which is going to be 1.8% monthly. Okay, so when you're charged your credit card, whatever your APR is, which it'll have to say, when you get a credit card, they send you like this paperwork that goes with it that tells the zone of your APR, because every credit card company has like a range of APRs that they charge, and people with better credit get a lower interest rate and people with worse credit get the higher interest rate. So when they send you that paperwork, you'll know it's in between one of those two numbers somewhere. When you get your first credit card statement, it has your actual APR on it. And then you can tell if they're charging you the correct one. You take your APR, you divide it by 12, and you do your calculation to see if they charged you correctly, which I'm going to show you how to do all that. Okay, when they calculate your interest, they use your average daily balance. Okay, so they take your whole billing period and they calculate the average that you owed each day. And you really do want them to do that, because let's say your billing period goes from the 1st to the 30th of the month, and you had a balance of maybe $10 all through the whole month, and then on the last day you charged $600. You would have only owed that $600 that one day. You wouldn't want them to charge interest on $600 for an entire month, because for 29 days you only owed $10. There was only one day that you owed $600, so you don't want to pay that much interest. So the average daily balance actually works in your favor. You end up paying less interest. And it's the calculation, I'm going to show you how to do it. Again, you have your days in your billing cycle, okay? For 7 days you owe this much, then you charge some stuff, and then for 3 days you owe that much, and then you pay some towards your bill, and so you owe this much. So your bill can go up and down throughout the month based on what you do, whether you've made payments, whether you've charged things, whether you've returned stuff and it got credited back to your account. So to find the average daily balance, you take the number of days times the amount for each. Okay, so I'm going to do 7 times 40, 456, 11, and then 3 times 11, 77, 60 as I go through. Then you add all these together, and then you divide by the total number of days. Okay, so for my total number of days, 7 and 3 is 10, and 6 and 9 is 15, so that's 25, plus 5 is 30. So there's 30 days total. So far, okay? So what I'm going to do is I'm going to do 7 times 4, 56, 11. I'm going to do 3 times 11, 77, 60. 6 times 9, 90, 08. 9 times 2, 1, 1, 5, 1, 5. And 5 times 2, 2, 0, 9, 1, 3. Okay. Once I multiply those, once these are all multiplied, I'm going to add them all together. So add these. Okay. And my total is $43,248.05. Obviously, you wouldn't want to pay interest on that. So then we take this amount and we divide it by the number of days in the billing cycle. And that gives me my average daily balance. This is the amount I pay interest on. And you can see on the last day of her billing cycle, she owed $2,209. You don't want to pay interest on this if this was your average. This saves money. Okay, so here's her average daily balance, and her APR is 18%. So first we have to find her monthly percentage rate. So we have to divide 18 by 12, and we get 1.5%. Okay. So you're going to pay 1.5% of that $1,441.60. Which means we first have to convert this to a decimal before we can do any math with it. So it's going to be 0.015 times your average daily balance. And depending on who you bank with or who your credit card's with, they'll say either interest or finance charge. Interest and finance charges are the same thing. So those two words are this one word with those two words are interchangeable. Okay, so the billing cycle is a predetermined amount of time that's set by the credit card company. And it's used for calculations for your bill. It can be 30 days. It can be an actual calendar month, you know, like the first and the last day of the month. And it can change. So, like people with poorer credit can have a shorter billing cycle. They might do that. So it just sort of depends. The accounting is a list of the credits and debits. Credits are payments. Debits are purchases. Okay. And these are payments to the card and purchases on the card. Okay. Your account number is a unique identifier assigned to your account. Everybody has a different one. It's printed on the front of the credit card. Well, not printed, it's embossed, I guess. You know, it's raised. Your credit line is the maximum amount you can owe at any time. Credit line is based on your credit initially, and then based on history after that. So.
Can I borrow Anthony Martinez for a quick second?
No, he's not here.
He's not here? Okay, sorry, thanks.
First, it's based on your credit. So when you first open a credit card, they base your credit line on your credit history. But then after you've had the credit card for a long time or for a while, based on your history with that credit card itself. So if you're making on-time payments and you're doing a good thing, they can extend your credit line. If you're not making on-time payments and you're not doing a good job, they can actually reduce your credit line. So it can fluctuate based on that kind of stuff. Then your available credit is the difference between what you actually owe and your maximum amount that you're allowed to owe. So you just take what you owe, you subtract it from how much you're allowed to owe, and that's how much you're allowed to still spend. On your credit card statement, it lists these things. You've got your billing date, which is the day that they process the payment, and depending on the company, that could be like during the actual day sometime, or it can be after the close of business on that day and they run the reports. The payment due date is the date the payment must be received by. So not the day you mail it by, but the day they have to receive it by. If they don't receive it by this date, you'll get a late charge. Okay, transactions are purchases made, the date, the total, the name of the company, and then also payments that you've made. Now, on these, the date, it can be the actual date, or it can be the received date. So, depending on the way your company processes things, when you look at the list of dates, it could be the actual day you were at the store, or it might be a day or two later, depending on how long it took them to process it. They don't list an itemized total. So if you go to, say, Target and you buy 22 different things and you spend $114, it'll say the date, it'll say Target, it'll say $114, but it doesn't list the items that you bought. Okay. Debits are the amounts charged to the account. These are positive. And then credit is the amount that's paid on the account, and those are negative. And that seems sort of backwards. But it's negative because it's deducted from the amount you owed. Okay, and then the previous balance is any money owed before the new billing cycle began. So this is your balance from the previous month or previous cycle. Basically whatever you didn't already pay off. Okay, at the bottom of your credit card statement, there's going to be a summary section. Summary. Okay, and in the summary section, the previous balance will be listed, which we just talked about. Payments and credits. This is the total amount of all money received by company, and that can be like payments that you made, or returns that you maybe made, anything that got paid onto the account to deduct or to reduce the balance. They'll be all put together. Then you have a section that says new purchases. This is the total of all of your transactions that you've made, all of the purchases that you've made. Then there's a part which is late charge. Now the late charge is if the last payment you made was late. So let's say it's June right now, and you get your June credit card bill. If you paid your May credit card bill late, your late charge will show up on your June bill. Does that make sense? Because, you know, they wouldn't know to put a late charge on there until after it already happened. Yeah. So it's this was the late payment from the last month if there's a late charge on there. Finance charge is any interest owed for the billing cycle. And then your new balance is your previous balance minus your payments, plus any new purchases, plus any late charges, plus your finance charges. And that's how you calculate your new balance. Finance charges. These are only charged if a balance is carried forward. Okay, so let's say you get a credit card and you charge $100 worth of stuff in June, and then you get your June bill and you pay $100. They can't charge you interest because you paid it off. They can only charge you interest if you don't pay the whole thing and you carry a balance forward. And then once you carry a balance forward, they can charge you interest on your average daily balance. But if you pay it off every single month and never carry a balance forward, you don't pay any interest. So the minimum payment, it's the lowest payment you're allowed to make without penalties. So if your minimum payment is $50, but you can't afford $50 that month, you can pay $25. They won't say, no, we're not taking your $25. They'll take your $25, but then they'll charge you like a late fee or a penalty of some kind for not making the minimum payment, which is better than not making any payment at all as far as your credit is concerned. Okay.
But that's what they want you to do, right? Is make the minimum payment.
They want you to make the minimum payment.
Yeah.
Okay, your average daily balance, we just did that. This is the average that the interest is charged from. The number of days in your billing cycle will also be listed. So you know how long your billing cycle is. Your APR is your annual percentage rate. And your monthly periodic rate is the APR divided by 12. Okay, which we've calculated. These are all listed at the bottom of your credit card statement. And these are things here. This you want to check. This you want to check and make sure they calculated it correctly. The list of transactions you want to check and make sure you actually made those transactions. Like, you know, let's say you're looking at your credit card statement and there's a charge on there from Just for Girls. That store Just for Girls, and you're not a girl and you've never been to Just for Girls, you don't have a daughter. Well, obviously that's not your charge. You need to say something about it and get it taken care of. Okay, so you'll have your sample statement. It'll have your name and your address, and the format of these can be different depending on how the company formats them, but all of the parts should still be there. So your account number may not be on there. Sometimes what they do is they do like dash, 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 whatever, and then the last four, you know, and all this is just dashes or star maybe, because they don't want to put the account number on the bill so that if somebody were to get it out of your mailbox, you know, for security purposes. The billing date, that's the day that they process the bill. The payment due date is the day that they have to receive their payment by. You've got your transactions. You'll notice that all of the purchases are positive and then the payment was negative. And that's because the purchases add to the amount you owe and the payment takes away from the amount you owe.
Wait, say that one more time.
The purchases are all positive, the payment's negative, because this is all adding to what you owe, and this takes away from what you owe.
Alright.
So that's why those are kind of backwards
Yeah.
from what you would think they should be. Okay, the previous balance, so Jane didn't pay $150 from the month before. She paid $75. She made $284 in purchases. She paid on time. Here's her finance charge. Here's her new balance, and here's her minimum payment. Here's her average daily balance. This is the number of days in the billing cycle. Her APR is 18%, and her monthly periodic rate is 1.5. Now you'll see her finance charge is a lot lower than her monthly payment, but that's also because she has a low rate. 18%, that's extremely low. The average credit card is more like 24%. 24 to 26 probably even. This person would have had excellent credit to get a rate that low. Probably the minimum you'd ever see is 15%, I would think. A couple questions. Keep your credit card statement out. I mean, we're going to have to kind of flip back and forth, but all right, so if we look at the summary portion, explain how the new purchases amount was determined. Well, if you go here, they took her previous balance, they subtracted her payments and credits, they added her new purchases, but wait, I'm answering the wrong question. Oh, new purchases amount. They added these up. They went from here to here, and this is new purchases. Okay, so they added up all the new transactions. Okay, and then B, the new balance amount, they took the previous balance minus the payment plus the new purchases plus a late charge if she had had one, which she didn't, but we'll put it in there anyway, plus the finance charge. Okay, so this is how we found the new balance. If you go back to your statement right here, her new purchases, she bought pizza for $75, sorry, gift shop for $75, and then she bought pizza for $31.85, and then she bought department store something or other for $139.10, and then she went to a bookstore and spent $38.50. Okay, so 9, 10, 18 plus 6 is 24, 10, 6, 8, carry 1, 284.45. 284.45. We matched. And then to do the new balance, we took her previous balance, which was $150.50. You subtract the payment. You add the new purchases. She didn't have a late charge. And then her finance charge was $353. Okay, and if we calculate all that, that's $75.50. Yeah, the 150 minus that. So you get 8, 5, 9. Well, here we go. 10 and 4 is 14. 5 and 4 is 9, 10, 13, 16. I don't know if I added that correctly. Yes, I did. 363.48. 363.48. So that's how you can check to make sure the new balance is matching correctly. Credit line of $15,000. So this is his maximum that he can spend. I think I might have made that a typo. I think it was supposed to be $1,500. But anyway, $15,000. Here's his summary. We want to know how much available credit does he have. Well, here's his current balance. Okay, so he currently owes $363.48. So we can take that $15,000. We subtract the $363.48 that he still owes. And his current credit line is $14,636.52 that he could spend. We've got a summary section, and she agrees with everything except the new balance. She's not so sure that this is correct. So we're going to check it. So in order to check the new balance, we do the previous balance minus the payments plus the new purchases plus any late charges plus any finance charges. Okay, so her previous balance was $17.48. She made a credit or payment of $100. She purchased $800. She had a late charge and a finance charge. If we do this math, we get 2, 4, 7, 6, 15. I think. Let me double check myself. Hold on. Okay, which is exactly $100 off from what they're saying. Well, if I had added 100 instead of subtracting 100, I would have gotten 2,676.15. So they didn't add the payment, but you can see that what happened here, if I had added 100 instead of subtracting 100, I'd be 100 off the other direction. So what they did is they neglected to count the payment at all. So you see how that worked? So they did not count her payment.
So you just overlooked it?
Yeah, because if I take that 100 out altogether, if I just say nothing, it'll actually equal 2,576.15. So they just neglected to count her payment at all.
And if she just let it go, she'd just get ripped off $100.
She would have just gotten ripped off $100. So you want to check it because things like that happen.
And
No, they're not even going to check. Do you know what I mean? Like, they won't check for that. So you need to check for that. And you can call them up and you can say, hey, no, you know, and they have to fix it. That's by law, they have to fix it. But if you didn't notice that, you'd be out $100 plus interest. Because they're going to charge you interest on that 100 that you paid, but then they don't show it's paid, so you get charged the interest on it. So you're out more than $100 at that point. So you want to be, that's what we know what the average daily balance is. It's the average amount owed per day. And we calculated it already when I gave you the 5 days at this amount, 9 days at this amount. But if you don't have those numbers of days, a credit calendar can be used to find the number of days. Okay, so you can use that to find the numbers of days and the balances to find the average daily balance. Okay, so we have this statement here from Elena. She went to Home Depot, she went to the bubble wrap shipping company, she made a payment. Here's all of her information at the bottom, her total credit line, her total available credit, her average daily balance, her APR, her new balance, at everything, but we want to check. We want to check if this is correct. Now we can check just using these numbers they gave us here and see if the new balance matches, and that's great, but we're taking their word for our finance charge at that point. We're saying, okay, well, they didn't make any mistakes here. Do we necessarily want to take their word for that? I don't know. I'm going to show you how to check it. To check it, first we have to verify this number. We have to verify the average daily balance. So, you do a 7 by 5. Okay, because this is 7 days in a week. And we have a 31-day billing cycle. So we have to have more than just 28 days. Because 7 by 4 is 28, so we have to have those extra days. Okay, so 7 days by 5 weeks gives me 35 days. Don't need all 35. I only need 31, so I cross out 4 days, which has already been done for you. Then we go through and we start with the billing date at the bottom. This is the day that they calculated the bill. We start at the bottom and we work backwards. And this is the beginning of the billing cycle. Okay. So we've got, you start at 11/13, you go backwards 12, 11, 10, 9, and you don't worry about the Monday through Friday thing. That's not we don't care about that. We just care about the dates. Okay. So our billing cycle started on the 14th of October. Looking at the statement, on the 25th of October, she spent $67. So we put $67 in there. If you go back again, you see that on October 29th, she spent $55, so that goes here. And then she made a payment on November 5th, so that goes there with a minus sign. So this is purchases and payments. Go next. By the date on the statement. Okay, so far with me? Yes, no? And you take the previous balance. So her previous balance, if we come back, oops, here's her previous balance. That goes on the very first day of your billing cycle, the previous balance, because that's the carryover. And you come across until you hit the next purchase or the payment. And then we add $67 to the $829.30. And that gives us $896.30. And so $896.30 gets put in that box because that's the new balance on that day, and it gets carried through until you hit the next payment. Which is $55, not payment, purchase, sorry. Which is $951.30. And that's what would go here. And it would be $951.30 after that point, all the way until the payment. And then you take the $951.30 and you subtract the payment of $160. And there were no other transactions, so it's that all the way through to the end. Okay, these are her balances and for how many days she had them. So what you do next, for all of these days, it was $829.30. Okay. Then for all of these days, it was $896.30. And then we had $951.30. Then a couple We had $791.30. Okay. So I had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days at $829.30. And then I had 1, 2, 3, 4 days at $896.30. And then 1, 2, 3, 4, 5, 6, 7 days at $951.30. And then 1, 2, 3, 4, 5, 6, 7, 8, 9 days at $791.30. So you count up the number of days at each balance and use those to find your average daily balance. So I'm going to go through and 11 times 829.30, and then 4 times 896.30, and then 7 times 951.30, and then 9 times 791.30. Add all these together and you get this 26,000. Divide it by the number of days and you get your average daily balance. And this should match your credit card statement. Now at first it seems kind of confusing, but once you've done it a few times, it's not too bad. It gets easier, it gets quicker. So her APR is 16.98%. 98%. Just make that prettier. Okay, so her monthly periodic rate, we need to divide that by 12. And then we check that against the statement and it does match. So they did that correctly. And then we turn that into a decimal. So it's 0.01415 times her average daily balance and we get 1209 for the finance charge, which we then take and we go back and we look at the statement and they said 1209, we say 1209, everything matches, it's all good. So I had 1, 2 days at 501.32. One, 2, 3, 4, 5, 6, 7, 8 days at 629.68. Five at 686.51. $16 at 733.84. Did I count that right? Yeah, 16. Okay. Okay. Add all those together. Divide it by 31 because there's 31 days in the billing cycle. And her average daily, or his average daily balance would be $684.32. And that was the answer for C. I can't always do these in order. I could find the finance charge without first finding the average daily balance. Okay. Once I found the average daily balance, here, let me go back. Let's do an A, B, C, D, and E. And this one we had to do first. And it is $684.32. Okay. Once I found the average daily balance, the next thing that's missing is the monthly periodic rate. That's D. And the monthly periodic rate was the APR divided by 12. So I have 21.6 divided by 12, which is going to give me 1.6%. So I had to find D second. Which is 0.016 as a decimal. Then I can find A. That's the finance charge. I take the average daily balance and I multiply it by the monthly periodic rate. $10.95 is her finance charge. His finance charge. I'll come right back. So I could do that third. And then the new balance is next. Okay, new balance. We do the previous balance, which is $576.32 from the statement, minus the payment of $75, plus the new purchases, plus a late charge if there was one, plus our finance charge of $10.95. When we add all that up and subtract the 75, we get $744.79. So that's fourth.
That plus zero is zero late charge.
Yeah, that was the late charge. You don't actually have to put it in there. I just put it in there so that people didn't forget the late charge. So this is previous. This is payment. This is new. That's late. And that's finance. Okay. And then finally, the last thing we want to find is the available balance. And the available balance is credit line minus the new balance. So our credit line here is $2,000. Our new balance is $744.79. So if I do 2,000 minus 744.79, my available balance would be 1255.21. Okay, I'll come right back to this. So you can do that last. Okay. So you have to find the average daily balance first before you can find the finance charge. And you have to know the finance charge before you can know the new balance. You have to know the new balance before you can know the available credit.